Rule number 1, never lose money. Rule number 2, never forget rule number 1.
The classic.
Right. It is arguably the most famous quote in the history of finance. It's the ultimate Warren Buffett mic drop.
Yeah, it's on the mugs, the T-shirts, literally every investing book introduction.
Exactly. But if I'm being totally honest with you today, it has actually always bothered me.
Bothered you? Really?
Yeah.
That's a pretty bold take on the Oracle of Omaha. What is it about the rule that rubs you the wrong way?
Well, it just feels a bit like a platitude, doesn't it?
Okay.
It's like, I don't know, like a basketball coach walking into the locker room before the big game and saying, all right, team, strategy for tonight, don't miss a shot.
Just put the ball in the hoop.
Right. Like, thanks, coach. I really hadn't thought of that one.
Right.
Because taken literally, it sounds completely impossible. It sounds like this insane standard of perfectionism. Because if never lose money meant you never close a trade in the red, or you never see a stock price dip below what you paid for it,
Then nobody would qualify.
literally no investor on earth, not even Buffett himself.
No, and you were absolutely right to challenge that literal interpretation. Because if you read that rule as be perfect or win every single hand, you are completely setting yourself up for failure.
Yeah.
And actually, if you look at the source materials we pulled for this deep dive Buffett's letters, the analyses of his career, he is the very first person to admit he's made massive mistakes.
Oh, for sure.
I mean, he has bought entire businesses that failed. He's misjudged industries. Look at the early textile mills he bought. He has definitely objectively lost money on specific bets.
Right. So we have to assume he's not just being a hypocrite.
Exactly.
He's obviously operating on a totally different wavelength when he says this.
He is, and we're usually just missing the point, which is why we're decoding this today, because that rule, it isn't about batting 1,000. It's not about never seeing red ink in your portfolio on a Tuesday.
So what is it?
It is a fundamental philosophy about something called capital protection. And honestly, this was the part of the source material that really grabbed me. Because if you misunderstand this rule, you tend to end up in one of two places.
If a jar.
You either become totally reckless because you just ignore the risk entirely.
Perfection's impossible anyway, so why try?
Exactly. Or you become completely paralyzed because you're so terrified of making a single mistake that you never invest at all.
Paralyzed or reckless. Neither of those sounds particularly great for your retirement account.
No, they don't.
So that is our mission for this deep dive. We're going to unpack what this famous rule actually means based on the sources. We'll look at the brutal mathematics of loss, which, spoiler alert for everyone listening, is way scarier than I initially thought.
Oh, it's terrifying.
Yeah. And then we'll get into this concept of a margin of safety. And finally, how on earth you actually apply these rules today. You know, in a modern environment where we have trading apps on our phones and these 24/7 news cycles just screaming at us to act.
It is a completely different environment than when Buffett started out, but the principles are actually even more critical now.
Because the friction is gone.
Exactly. The friction to make a massive mistake is basically zero now. But let's start with the foundation here. Why is rule number 1, never lose money?
Okay.
It comes down to something we call the asymmetry of investing.
Asymmetry. All right, let's unpack that because in my
Yeah.
head, just using simple arithmetic, if I lose $10, I just need to make $10 back to be even.
Right.
That feels perfectly symmetric to me. Up 10, down 10, we're back at 0.
And in absolute dollars, sure, you're right. But investing is a percentage game, and percentages are exactly where the trap lies. This is the math that beginners almost always ignore, but professionals totally obsess over.
Walk me through it.
Let's look at the numbers directly from the deep dive source. If you invest $100 and you take a 10% loss, where are you?
I have $90.
Right. Now, to get back to your original $100, you need to make back that $10. But, and here's the crucial key, you only have $90 to invest now. You have less fuel in your tank. So, a $10 gain on a $90 base isn't 10% anymore.
Oh, I see.
It's about 11.1%.
Okay, so a 10% loss requires an 11% gain. I mean, that's a slight penalty, almost like a tax on the loss.
A tax is a great way to put it.
But honestly, that's fairly negligible. I feel like that's a good week in a bull market. I can handle a 10% loss.
Exactly. A 10% loss is completely manageable. You can recover from that with standard average market returns. But here is the tipping point. This is where the asymmetry gets incredibly violent.
Okay, brace me.
Let's say you take a really catastrophic loss. You get wiped out on a bad earnings call or a crypto crash or whatever. You lose 50% of your capital.
Ouch.
Yeah. You had $100, now you have 50. To get back to 100, you need to make $50.
Right.
What percentage gain is that on your remaining 50 bucks?
Oh, wow. I see where you're going with this. If I have 50 and I need to get to 100, I have to completely double my money. That is a 100% gain.
Precisely. The math has completely turned against you at this point. You lose 50%, but you don't need a 50% recovery. You need a 100% gain just to break even.
Just to get back to the starting line.
Exactly. You need a miracle at that point. Do you know how hard it is to actually double your money safely?
Well, in the stock market, the historical average return is what, like 8 to 10% a year?
Right around there, yeah. So let's play that out. If you need a 100% gain, and you are compounding at a normal responsible rate of, say, 10%, it is going to take you roughly 7 years just to get back to where you started.
Wait, 7 years?
7 years.
Just to get back to zero?
7 years of your life. 7 years where your money wasn't growing for your future, it was just healing from the damage.
Yeah.
That is the time cost of loss that nobody really talks about.
That is, wow, that is really sobering.
Yeah, when Buffett says never lose money, he isn't saying don't make small mistakes. He's saying never put yourself in a hole so deep that you have to spend the next decade of your life just trying to climb out.
It totally changes the perspective on that phrase we always hear, high risk, high reward.
Completely.
We tend to focus entirely on the reward side, like, oh, I could double my money in a month. But the math really implies that the penalty for the risk is incredibly disproportionate. You're risking your time, not just your dollars.
You are. And the math does not care about your confidence. It doesn't care about your thesis on the stock or how much you love the CEO. Large losses destroy your ability to compound. And compounding is the entire game in investing.
Right.
If you interrupt that compounding process with a massive 50% drawdown, you aren't just losing money, you're losing time. And time is the one single asset you can never buy back.
That's a huge mindset shift. I feel like when most of us start investing, we look at a stock, maybe it's a tech startup, whatever, and we ask, how much can this go up?
We look at the ceiling.
Yeah. We're dreaming of the moon. We're essentially counting the money before we've even made it.
And that is the classic beginner mindset. What's the upside? But the smart investors, the ones we found in the source material who stay in the game for decades, they invert the problem entirely.
They look at the floor.
Exactly. They ask, how much can I lose? And more importantly, can I survive it?
Can I survive it? That's a heavy question, but it makes perfect sense. Because if you get knocked out of the game entirely, you obviously can't win.
Right.
So the practical question for you listening is, how do we actually do that? How do we proactively prevent these massive 50% drops? Because nobody buys a stock thinking it's going to tank. Y'all think we're picking the winners.
Of course we do. This brings us right to the second major pillar of our deep dive today. The margin of safety.
Margin of safety.
Yes, this is a concept Buffett actually picked up from his mentor, Benjamin Graham. And it is the primary tool for avoiding those mathematical disasters we just walked through.
I've heard that term thrown around a lot, usually by, value investors wearing suits on financial news networks.
Sure.
But break it down for us. What does a margin of safety actually look like in practice for a normal person?
Okay. Imagine you are building a bridge.
Okay.
You do all the math, and you calculate that the absolute heaviest truck that will ever drive across this bridge weighs exactly 10,000 pounds.
Got it.
When you build the bridge, do you build it to hold exactly 10,000 pounds?
Absolutely not. That's terrifying, because if the truck driver had a big lunch, the bridge collapses.
Exactly.
You build it to hold, 30,000 pounds.
Right. You build it for 30,000 pounds. That extra capacity, that 20,000-pound buffer you built in that, is your margin of safety.
Okay.
You don't ever expect a 30,000-pound truck. But if you're wrong about your original math, or if there's an unexpected storm, or the materials degrade over time, the bridge doesn't collapse.
That makes perfect sense in engineering.
Yeah.
Nobody wants a bridge that's just strong enough.
Yeah.
But how do you build a bridge like that when you're buying a stock?
It all comes down to understanding the difference between price and value.
Okay.
And this is the core tenet of the whole philosophy. Price is what you pay. Value is what you get. The margin of safety is simply insisting on buying an asset for less than it is fundamentally worth.
So finding a discount.
Right. If you do the work and you calculate that a business is truly worth $100 per share, you do not pay $100.
You wait for a sale.
You wait until you can buy it for $70.
Oh, wow.
That $30 gap between the price and the value, that's your buffer. That is the extra concrete in your bridge.
But why, though? If it's truly worth $100, isn't paying $100 fair?
It is completely fair, assuming you are perfect. But remember, the whole point of this, we aren't perfect. The margin of safety isn't just about getting a bargain so you can make more profit, though obviously that's a very nice bonus.
Right.
It is fundamentally a cushion against human error and unpredictability.
Because things go wrong.
Always. Maybe a broad economy slows down. Maybe the star CEO suddenly quits. Maybe a competitor invents a slightly better product. Or honestly, maybe your initial analysis was just completely flawed and the company is actually only worth $85.
I really like that framing. It's essentially an admission of humility.
Yes,
It's basically you saying to the market, hey, I might be wrong here, so I need to price in my own stupidity.
that is the exact way to look at it.
Because if I pay $70 for something I think is worth $100, and I'm totally wrong, and it turns out it's actually only worth $80, I still made money.
Exactly. You can be wrong and still win. That's the magic. But if you pay $100 or worse, if you pay $120 because everyone on social media is hyping it up to the moon,
Oh, man. Yeah.
and then the value drops to 80,
Right?
now you've just lost 33% of your capital. You are deep in the hole.
This feels like the exact opposite of what happens during a massive bull market.
Complete opposite.
Because when everyone is excited, we see people happily paying double, triple, sometimes 10 times what a company is fundamentally worth because, well, just because everyone else is doing it.
FOMO is real.
We totally rationalize it. We say things like, oh, it's a new paradigm. Traditional metrics don't apply anymore.
Right. And in the sources, that exact behavior is called optimism with leverage.
Optimism with leverage.
Yeah. And it's not investing, it's hoping. Most investors just fall in love with the story. They say, this company is going to change the world.
And it might.
And maybe it will. But if you pay a stock price that demands absolute perfection, a price that assumes 20 straight years of flawless execution, and they stumble even just a little bit,
Right.
the math turns against you instantly.
Optimism with leverage. That is a dangerous cocktail. And I think that transitions us perfectly to the modern world. Because, let's be real here, avoiding that kind of hype is vastly harder today than it was in Buffett's early days.
Oh, absolutely.
He didn't have a supercomputer in his pocket, buzzing with hot stock alerts every 5 minutes. He didn't have online forums pumping meme stocks up 400% in a single afternoon.
It is a completely different landscape today. We have instant access to information, constant social media hype, and these options trading apps that literally gamify the whole experience.
Right.
It has never been easier to act fast, but the sources argue it has never been harder to actually think clearly. The modern game is basically rigged to make you break rule number 1.
I completely agree. The friction is completely gone. I mean, you can lose your entire life savings with a quick Face ID scan while you're waiting in line for your morning latte.
It's terrifying how easy it is.
It feels like the apps are specifically designed to bypass that whole margin of safety thinking we just talked about and tap directly into our dopamine receptors. You literally get digital confetti when you execute a trade.
But you get zero confetti when you wisely decide not to trade.
Exactly. So, in this crazy environment of speed and noise, how on earth do we actually apply never lose money?
We have to actively redefine the rules of engagement for the modern era. Look, we can't just sit alone in a room reading annual reports for 10 hours a day like Buffett did, but we can set up non-negotiable guardrails.
Okay, I like guardrails.
The source material lists a few very specific modern don'ts to protect yourself.
Hit us with them. What are the guardrails?
Guardrail number 1, don't over-concentrate in one idea. Guardrail number 2, don't use leverage emotionally. And guardrail number 3, don't invest in things you don't actually understand.
Let's drill down on that first one, the over-concentration piece. Because I see this constantly online. People just going all in on a single stock. The classic YOLO trade.
Right.
It's treated almost like a badge of honor in some communities. Like, I believed in this company so much, I put my whole life savings on black.
YOLO, you only live once, is a absolutely terrible investment strategy. I mean, it's a great strategy if you're going skydiving, maybe, but not for building wealth.
Definitely not.
If you put 50% of your net worth into one single stock, you have already deeply violated rule number 1, no matter how amazing that company is.
Wait, really? Even if it's an incredible company, even if it's the next Amazon or Apple?
Even if it is the best company in the history of the world.
Why?
Because of what we call black swan events.
Okay.
Think about it. Massive regulatory shifts, unpredictable leadership scandals, a sudden global pandemic, a massive fraud hidden deep in the accounting. Things happen that absolutely no financial model can predict.
Right, the true unknowns.
Yes, and if you are entirely all in, you have zero margin of safety against the unknown. Position sizing, which is just deciding, hey, I will only ever put 5% of my capital into this one idea that is actually your very first line of defense.
So never lose money isn't just about what you choose to buy, it's actually about how much of it you buy.
Precisely. Ego tells you, I know I'm right, bet the house. Discipline says, I might be right, but let me size this position so that if I'm somehow wrong, I'm still in the game tomorrow.
That's good.
Ego doesn't manage risk. Discipline does.
Ego doesn't manage risk. That is going on a sticky note on my monitor for sure. But there's another really interesting layer here that the source material brought up. And honestly, I think it's the most relatable part of this whole deep dive.
The psychological side.
Yes. It's not just about losing financial capital. It is about emotional capital.
This is a huge concept, and it's so often ignored in finance because you can't neatly track it on a spreadsheet.
Right.
But when you take a really massive loss, you do not just lose dollars, you lose your confidence, you lose your cool. We have all felt it.
Oh, I have definitely been there. You're just staring at the screen, you see that huge red number, and you get this literal physical pit in your stomach.
Your heart rate spikes.
Your heart rate goes up. And then, honestly, you get angry. You feel like the market somehow reached into your pocket and stole from you, and you just want to fight back.
Exactly. And that exact anger leads to one of the most destructive behaviors in the entire investing world: revenge trading.
Revenge trading. It sounds like the title of a terrible action movie.
It does, but it's a very real psychological phenomenon. It is essentially going on tilt in poker.
Oh, okay.
You take a hit and you try to make the money back quickly. You completely abandon your pre-planned strategy. You start taking much bigger risks on much lower quality setups purely because you want to erase the pain of that initial loss.
You're just thinking, if I can just double this next random trade, I'm back to even and the pain goes away.
Right. And because you are now acting purely on emotion and not logic,
You usually lose again.
you almost always lose again. And now you are caught in a spiral. That is exactly how one bad decision cascades into 5 bad decisions.
Wow.
That initial loss, it might have actually been perfectly recoverable. Maybe it was just that 10% dip we talked about earlier. But the subsequent emotional decisions you made in a panic, that is what actually wipes out your account.
That is such a powerful insight. So capital protection is really, at its core, emotional protection.
Yes. By actively avoiding the really big drawdowns, you keep your head clear. You keep your emotional capital intact.
Which gives you an edge.
A massive long-term edge, because it allows you to remain completely rational when everyone else is completely freaking out. Think about it. When the entire market is crashing, the person who protected their downside earlier is the only person calm enough to actually step in and buy the dip.
That makes perfect sense. If you aren't bleeding out yourself, you don't feel this desperate need to apply a tourniquet with your teeth. You can just stop, look around, and think. You preserve your mental bandwidth.
Exactly. In investing, raw IQ is completely secondary to temperament.
Okay, we have covered the heavy math, the underlying philosophy, the psychology, but I want to give you listening something incredibly concrete to walk away with. Say someone is sitting there right now, maybe looking at a ticker symbol flashing green on their app, feeling that FOMO kicking into high gear.
Yeah.
Is there a practical tool, like a specific check they could use to apply this rule right now?
There absolutely is. The source material provides what they call a discipline filter.
Okay.
It acts as a mental pause button. It's just a single, simple question you force yourself to ask before you ever click buy.
All right, I'm ready. What is the magic question?
The question is, if I were already up 20% today, would I still take this trade?
If I were up 20% today, that's really interesting. Walk me through the psychological logic there. Why does that specific hypothetical matter?
Well, think about when you usually make your worst financial decisions.
Usually when I'm stressed.
Right. It's usually when you are already down and feeling desperate to make the money back, that revenge trading we just discussed. Or it's when you're feeling left out of a rally, dealing with FOMO.
Yeah.
In both scenarios, you are reacting to your current emotional state. You are operating from a feeling of lack.
Right. I'm chasing. I'm trying to desperately fill a hole in my portfolio or my ego.
Exactly. But if you pause and imagine that you are already up 20% for the day, you're feeling great, your account is secure, the rent is paid, you have absolutely nothing left to prove to anybody,
Okay.
would you still look at this specific, highly risky trade and say, yes, this perfectly fits my long-term strategy?
And if the honest answer is no,
If the answer is no, then you are not investing. You are just reacting. You are trying to fix a temporary feeling, not build long-term wealth.
That is incredibly powerful
Right.
because it forces you to completely divorce the actual trade from your current feelings. It's a built-in sanity check. Like, do I actually want to own this asset or do I just desperately want to win today?
Exactly. It removes the emotion and forces clarity. And clarity is literally the only way you can adhere to rule number one. You cannot see the margin of safety if you are completely blinded by FOMO or fear.
I really love that. It's a
Mhm.
simple, effective pause button. And honestly, in a world defined by instant execution, a pause button is probably the single most valuable tool we could possibly have.
It absolutely is.
So let's bring this all back home. We started this deep dive with a famous quote that frankly sounded impossible: never lose money.
Right.
But as we've peeled back all the layers from the sources today, it turns out it's really not about demanding perfection. It's not about being some financial wizard who magically never picks a losing stock.
Not at all. Never lose money is simply a mandate to respect uncertainty.
Yeah,
It means actively demanding a margin of safety, paying 70 cents for a dollar of value so that you can survive the inevitable experience of being wrong.
right.
It means intelligently sizing your position so that no single random event, no matter how crazy, can ever take you entirely out of the game. And ultimately, it means protecting your peace of mind so you don't fall into the destructive trap of revenge trading.
So it's essentially prioritizing your survival over hitting the jackpot.
That is the absolute key. The goal of investing isn't to win every single trade you make. You won't. You can't. The real goal is to survive long enough for compounding to actually work its magic. Compounding is exactly like a snowball rolling down a hill. It needs a really long hill to get massively big. If you blow up your account with one terrible risk, you've stopped the snowball. You have to walk all the way back to the top of the hill and start over with a tiny handful of flakes.
Time is the secret ingredient. But time only works its magic if you're still standing on the hill.
Exactly. Consistent return is the reward for discipline. If you can
Wow.
just stay in the game, the wins will eventually take care of themselves. The market heavily rewards survivors.
I think that is a absolutely perfect place to wrap up our deep dive today. But before we go, I know you always have one last thing for us to chew on, something provocative for the listeners to take with them into the week.
I do. Look, we live in a culture that is totally obsessed with speed.
Oh, yeah.
Get rich quick, retire by 30, trade options from a beach in Bali. The culture makes us feel like we have to be constantly aggressive to succeed. Like if you aren't trading every day, you're losing.
It's exhausting.
It is. But I want you to consider this thought instead. In a modern world absolutely defined by speed, the most aggressively profitable move you can actually make is to intentionally move slowly enough to ensure you never get knocked out of the game completely.
Moving slow is the ultimate aggression. I really like that. It goes against literally everything my Instagram feed tells me.
That's because time is your greatest asset. But time only works for you if you still have chips left on the table. Don't let the societal need for speed steal your financial longevity. We all know the story. The tortoise doesn't just eventually beat the hare. The tortoise is the only one who actually finishes the race. The hare usually blows up his entire account on zero-day options halfway through the first lap.
The hare blows up his account. I love that. That is definitely going to stick with me. Listeners, thank you so much for diving deep with us today. Hopefully, Buffett's rule number one makes a whole lot more sense to you now. It's not about being boring. It's about being bulletproof. Stay disciplined, protect that capital, and we will see you on the next deep dive.
Stay safe.